Hey there, everyone. Today on the Final Bar, happy Fed Week. The S&P, the NASDAQ, largely unchanged as we await the latest from Powell and Company on Wednesday. Higher crude oil prices mean higher energy stocks. We're seeing that again today. More of the same through the course of this week and beyond. Special segment today, banking on breadth. Do you see signs of further weakness for our equity benchmarks when you review this breadth analysis? Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. Happy Monday. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit really designed to help you navigate uncertain times by focusing less on what could happen or what should happen, but what actually is happening. We had so much fun over the last week here at Stock Charts, having Julius de Kempener in from Amsterdam, and also the great Ralph Acampora. I had the pleasure of interviewing him right on our interview set on Thursday of last week. We had a lot of really good conversations. Also, we presented at Stock Charts, partnering with the CMT Association on Saturday. And so I'm sort of coming to this Monday episode with a lot of fresh Ralph ideas in my head. Things like keeping it simple, which is one of the core tenets he kept coming back to. Focusing on the basic message of price action, higher highs, higher lows, recognizing when the evidence changes, not being afraid to take a bold call, but also not being afraid to change your call if the evidence suggests it. So hopefully this show gives you a little taste of Ralph's wisdom as we talk about trends and we focus on breadth conditions today. You know, again, it's sort of an uncertain period as we sort of wait for the Fed meeting Tuesday into Wednesday. Not really an expectation of any change in rates, but certainly a lot of people will be focusing on the Fed's dot plot, their projection of future rate hikes or rate cuts, and also just the tone of Powell and others as they speak to the conversations that have been had. With that as a backdrop, let's look at what happened in today's relatively quiet session as we get to our market recap. Before we bring up the charts, before we look at the change in the major averages, just a quick question that we asked you over the weekend. What's your average investment horizon? A couple minutes, a couple days, a couple months, a couple years? Keep it simple. Over half of you said a couple of years, and that sounds about right. That tracks, right? We have a lot of long-term investors that use the Stock Charts platform and also are looking way down the road, managing a retirement account, sending kids to school, thinking about estate planning and those sorts of things. And I will tell you, the good news is that long-term charts, particularly weekly, monthly charts, some of those bigger time frames, can be super helpful at helping you just understand the broader secular trends. And things like stocks versus bonds, some of those ratio charts that can help you understand the interest rate environment and how it's impacting different stocks and sectors, super valuable on those time frames. However you answer that question, if you are a couple of minutes person or a couple of months person or somewhere in between, recognize that all of those time frames are kind of interrelated. People like Bob Prechter and Elliott and others talked about the fractal nature of markets, that patterns and movements and sentiment can be measured on very short time frames and very long-term time frames. Always think about those different time frames, how they're interrelated. So whichever one you answered, don't forget about those other time frames because those can be pretty helpful to understand as well. With that in mind, let's look at what happened today and then connect it to the bigger picture as much as we can. Really a quiet day here, and Friday was a triple witching day, which means it's options expiration, futures expiration, all of that happened. It was kind of a spike in volume, and that was less a big change in sentiment and more a lot of the logistical changes that have to happen the third Friday of every month for options and such. So today, not surprisingly, a bit of a quieter day relative to what we saw on Friday. Now, Friday really didn't directionally move a significant place, but there was a lot more volume. Today, the S&P and the NASDAQ essentially flat for the day, the Dow as well. So the S&P really finishing right about where it started, around 4453. The NASDAQ composite just above 13,700. Mid caps and small caps a little more red. The small cap S&P 600 index was down about 0.6%, and the VIX pushing a little bit higher, not too much, just above 14 or so. Now, if you asked me to sketch out what would Monday and Tuesday look like when we're sort of waiting to see what the Fed does on Wednesday, I would say probably lighter volume, probably not big macro moves, certainly could be some individual stock moves, things like Tesla and others, moving because of an analyst upgrade or downgrade. But in general, this is one of those wait and see sorts of periods. So I would expect less movements probably less general volatility until we get to Wednesday. And you have to remember, it's not just about the Fed here in the U.S., although that's certainly top of mind for us. The UK Central Bank, Japan, I think Switzerland, others, all coming through sort of between now and the end of the week. I think most of those are on Thursday, if I remember right, Wednesday into Thursday. So it's not just about the U.S., although that is certainly an area I would be focused on more than anything, certainly if you're a U.S.-based investor. But it's also a lot about central banks generally and what tone we set for the next month or two until we get the next decision and a potential rate hike, which is what the markets are currently pricing in. Speaking of interest rates, not much of a change from yesterday. Again, the 10-year yield holding steady around 4, we'll call it 432. The 30-year long bond yield just below 4.4%. 5-year point right around 4.5, just below that. And the short-term point about 5.3%. So still we have that inverted yield curve. I'm hearing a lot more discussions as we get closer to the end of this year, talking about recessions into 2024 and what that might mean for risk assets. Not particularly rosy outlooks, but talking to people like Gary Wald and others that we've had as guests on the show recently, David Cox of Raymond James, some of the others, there's still plenty of constructive price action, right? And as much as there are reasons why the market should go down or could go down, you're not necessarily seeing that. You're not seeing huge breakdowns across the board. We'll look at breadth a little bit later in the show today. Draw your own conclusions on the evidence that we share with you. So bond prices a little bit higher. The TLT was up about 0.6%. And the dollar down slightly, about 0.2% lower for the UUP. Looking at commodities, we're going to look at a chart of the DBC, I think, or maybe the CRB index, I forget which one, looking at long-term trends in commodities. But overall, it's been a nice rally phase for the commodity space, generally speaking. We've talked about crude oil prices. Brent crude prices spiked up to around 95 earlier today before the show. Gold and silver prices up as well. The GLD was up 0.6%, silver up 0.9%. Finally, cryptocurrencies. More and more green now. Bitcoin spiked up to over 27,000 at 27,400 earlier today. Back down just below 27,000, but again, showing nice resilience, a nice bounce off of support around 25K for Bitcoin. That's in the last couple weeks. We've seen once again a retest of that support level bouncing to the upside. Ether prices just around 1640 as well. So most of the top 10 cryptocurrencies that we track all in the green today. Finally, let's look at some sectors. The energy sector back at the top of the list today. Last week, we had a couple days where it was more defensive sectors like utilities or real estate at the top. Today, back to sort of a familiar pattern we've seen, which is energy at the top and then everything else. Now, technology, the XOK was second, up 0.5%, in the financial sector, spot number 3, up 0.3%. A couple of sectors down. Consumer discretionary was down about 1.1%. Tesla got downgraded. We'll look at that chart here in a minute. Again, not broken. These are not horribly broken charts, but they're certainly not going up at the moment. I think that's something to certainly recognize and acknowledge if you're not there yet. Real estate second from the bottom, and then materials down about 0.4%. Just one more. I wanted to look at what I call the Magnificent Seven and Friends. These are the seven sort of mega cap growth names, things like Apple, Meta, Alphabet, and others. Look at the dispersion, or what we call sort of the difference from the biggest gainer today, Apple up 1.7%, the biggest loser, Tesla down 3.3%. Everything else kind of in the middle. What's interesting is you have a chart like Alphabet, kind of steady uptrend, consistent higher highs and higher lows. At the same time, you have like a Microsoft or an Apple really breaking through the 50-day, bouncing a little bit, but still putting in lower highs and lower lows for now. So I think a bit of a disagreement between this group of stocks. I think you're seeing some that are still holding up quite well. NVIDIA and Alphabet stick out in my head, and others that are really starting to break down. Maybe Tesla's a good example of that difference. Let's get to some of these charts here in a minute, but before we do so, let's look at a chart of the S&P 500, sort of set the stage with where we're at. Now, I always talk about sort of my base case because I think it's good to have an idea of what you think is most likely to happen, but then be open to other scenarios and what other things could actually happen. The S&P 500 putting in a lower peak for now. It certainly appears to be a lower peak here at the end of August. It's right around the, I almost said 4th of July holiday. Labor Day is what we had a couple weeks ago there on that Monday holiday. Sort of pulled back there, and overall still sort of holding steady after that rally. So we rallied out of the August low, and then we've sort of been holding water. If you take a step back, it's hard for me to see this as anything but a head and shoulders pattern or a potential head and shoulders pattern. What you have to remember with this sort of pattern, there's three parts to it, which we shared a couple times last week, right? There's the setup, which is where I think we're at. It looks like it might be a head and shoulders pattern. It is showing all the signs. It's including the 50-day moving average. It's putting in a clear lower peak. We have a well-defined neckline. The second part is what's called the trigger, which is where you actually complete the pattern. And you have to remember that pattern like this is not really bearish until you break the neckline. And so that's why, at this point, breaking below 43.50 is kind of the trigger that would indicate that head and shoulders pattern is completed. Then there's that crucial third piece, which is confirmation or some sort of follow through, right? Some sort of additional move to the downside, some recognition from the markets that it's not just a whipsaw, but that there's an additional move to the downside. John Murphy talks about, I think he called them follow through days, but I forget specific lingos that each sort of mentor sort of use. But I know John in his books talks about the necessary additional movements, suggesting that it wasn't just a fluke, that there's something more there. So it could definitely be a head and shoulders top. We've had a lot of questions about the S&P, about the Russell 2000 and others. Is this a head and shoulders top? And the best answer I could give you is until you break that neckline, the most you can say about it is a potential head and shoulders top. Certainly looking like one, but until we break the neckline, it's not sort of there yet. It's not really giving a clear signal. Now, we highlighted some of those divergences that we recognized in June, July, even August on some of the charts. We'll look at some of the individual names that sort of, parts of the S&P 500. Before we do that, I wanted to look at some of the other asset classes here very briefly, just two charts in particular. Now, there's a lot of discussion in the news today about crude oil prices, and it was actually Brent crude. And I just wanted to make a quick point. You have to remember there are kind of two main benchmarks you can follow, and we have them both on the Stock Charts platform. WTI Cushing is sort of the main U.S. crude oil benchmark. This is based in Texas. That's what WTI is, West Texas Intermediate crude. So $WTIC tracks the crude oil futures for that U.S. crude oil benchmark. So if you want to know where crude oil is, you're talking to someone in the U.S., they're most likely talking about what WTI crude oil, which is $WTIC. If you're talking to someone in Europe, they're probably more likely talking about Brent crude, which is the European benchmark, $Brent on our platform. Same thing, it's using futures contracts or commodities to string together a continuous contract. This is the one that was up around 95. I had some people saying that they saw on the news that crude oil was hitting 95. They didn't understand what was happening. I think that was Brent crude that they were referring to, sort of getting up there intraday. So two benchmarks. Now, both of these benchmarks, if you look at them, very similar, and there are times when they differ. It tells you a little bit about situations and supply and demand in different parts of the world. But for now, I would say they're both very much in agreement. They both establish a pretty clear resistance level in the form of, in the case of crude oil, U.S. crude oil is around 83, 84. We broke above there, and now we've continued to push higher. If you take a Fibonacci analysis, we've broken above that first Fibonacci level. So, in my observation, it certainly seems like crude oil is pounding out a consistent pattern of higher highs and higher lows, both WTI crude oil and Brent crude oil, those two main global benchmarks that I just mentioned. You're also seeing a nice bounce higher in Bitcoin, which is interesting as well. Sort of trading higher, trading a really choppy session today. So at this point, we're sort of in the lower half of the range over the last 15 hours or so. I forget when the cutoff is because it's traded 24 hours. But for now, sort of testing that 50-day moving average. And I think the real key when you take a step back on the chart of Bitcoin are two levels, right? The support level around 25,000, the resistance around, we'll call it 30 to 31,000, depending on where you want to draw that line. I'm comfortable saying around 31,000. So got about a 6,000 point range from clear support to clear resistance. And when we traded down here in mid-August, we never broke it, right? We sort of traded the worst of the lowest we were sort of after Labor Day, but now rotated it back to the upside. So I would say until we break below 25K or break above 31K, one of those things is going to happen at some point. Until then, this is a sideways market. This is a consolidation phase, and you either are betting on mean reversion and sort of buying weakness and selling strength and then expecting some sort of range-bound condition to continue, or you're being patient and you're waiting for a break to new swing highs or a break to new swing lows. And I would argue whichever break you see first, most likely that's the direction of overwhelming momentum going forward. Let's look at some of the individual names. I'd mentioned, the S&P 500, sort of the conditions there. As I'm thinking of my conversations with Ralph over the last 5 days or so. And again, what a pleasure to spend time with a mentor like that. He was giving a presentation on Saturday and just talking about the simplicity, keeping it simple and focusing on the key evidence as defined by the trend. And I'm thinking, what would Ralph say about the chart of Apple? I think he would say two different things depending on the time frame. And one of those is, on this daily chart that we're looking at over the last 2 years, are we making higher highs or lower highs? And I think with this lower peak in 190, pretty clear we're making a lower high. Are we making higher lows or lower lows? And I would say, this most recent one in August really dropped quite a bit after these series of higher lows there. And so the fact that we've been unable to make a new high and now pretty close to undercutting that low, I would say getting below that, we'll call it 173 level, which was the low from, the closing low from mid-August, kind of where we're at yet again over the last week. We're really close from this looking like a clear distribution pattern. That's the concern I have for our major benchmarks today, is that we're really close to a chart like Apple going from being, sort of a choppy consolidation to a really negative, rotation if we would break below that support and confirm a lower low after confirming a lower high. Charts like NVIDIA, not there yet. And there's a real difference between Apple making a clear lower high and NVIDIA most recently making a higher high, right? According to that basic methodology, we just came off of a new high. For now, we're still making a new low or higher low. And as long as we hold 400 on any sort of pullback here, this is still a strong chart. And this is where I start to say there's a bit of a disagreement between some of those large cap growth names. Now, the momentum, I would say clearly negative, right? And that's, again, the concern I have on a chart like NVIDIA. It's not that we're breaking down yet. It's just that the momentum is telling me that we're at an exhaustion point. It tells me we're in the 9th inning, if not overtime, of the baseball game here, and we're pretty close to a breakdown. But again, let's be patient. Break below 400 would be the trigger, in my opinion. This is a really good time, by the way, to set an alert on stock charts to get a notification when that, if and when that breakdown would actually play out. Looking at Tesla, one more sort of Magnificent Seven stock. And again, Tesla is an interesting chart because we had quite a pullback here from mid-July to mid-August, going from around 300 to around 220, just a little bit below there. That was a lot of ground to give back in about a 4-week period. From there, we almost regained back to the previous highs, but didn't do so. For now, we appear to be stalling out around 280 after today's drop. Stock is down about 3.3% on an analyst downgrade. If we would rotate lower, I think just like Apple, that confirms a lower peak. The momentum is certainly more negative or more classic for a bearish phase than a bullish phase. So, certainly looking more heavy, I guess is the way I would describe it. Again, I think the key is to see if we keep making a higher low. I would say with the chart of Tesla, we undercut the June low pretty clearly. So overall, it seems like a new swing low, a lower high. This is certainly more of a distributive chart than some of the other ones that we've been talking about. Now, with that in mind, there are a lot of other things to review. MSI, Motorola Solutions. I was looking at some of the telecom equipment names. I just wanted to point out charts like this. I don't want to say that what we do analyzing stocks and picking them and putting them in the portfolio is ever easy. It really is not. I think this is a challenging game, and it is a humbling way to spend your time, as I'm sure you have experienced firsthand if you've been trading stocks using any methodology for any period of time. But charts like MSI certainly make it seem pretty straightforward because we're in a clear sideways trend. And just like the chart of Bitcoin, just a much more compressed range. Look at how clearly we have support right around 275, we'll call it. Look how the 200-day moving average is right there. On the upside, 295, 297, that's where we hit resistance in May. Again in early July, again in late July. So you have a clear reference point, right? Clear resistance, clear support. Which way do we break? Do we hold support and find another bounce back to the previous highs, or do we break out of those range one way or the other? I think until we break, this is telling you it's a sideways trend, it's a market in consolidation. Be patient. When in doubt, be patient. We're going to get to our next segment, Banking on Breadth, here in a moment. Before we do it, just want to let you know about a couple quick things. First off, we would love to hear from you. We're going to do a mailbag segment on the Friday show of this week. We'd love to answer one of your questions on the air. Our email, it's the best way to get your questions to us. thefinalbar@stockcharts.com is the way to send them over. On Twitter/X, just tag us in a comment @FinalBarSCTV. And of course, on our YouTube channel, just drop a comment below the video you're watching. We'll gather all of those and hope to answer one of yours in our Friday show. We have a live Q&A coming up this Wednesday, every Wednesday at 1 p.m. Eastern, 10 a.m. Pacific. I set up in our podcast studio around the corner. We'll have a couple charts just to get the conversation started. It will be fueled by all of the live questions that come in. So it's a quick 30-minute discussion, but can go anywhere and everywhere you guys want to go. So make sure you tune in. If you go to our YouTube channel and go to our upcoming live broadcast, you can set a notification so you don't miss this Wednesday's live Q&A. And again, that's at 1 p.m. Eastern on our YouTube channel. Our next segment is called Banking on Breadth. Let's talk about some of the breadth conditions, thinking about some of the things that we could dig into today. And I think what I really came back to was just recognizing this difference, or I guess this differentiation between the benchmarks, which are dominated by large cap growth stocks. And now that we're starting to see some weakness in some of those key names, but not all of them, right? An NVDA making new highs, while an Apple clearly or a Tesla clearly is not. You can also look at measures of breadth, and that's a way of not just looking at 2 or 3 tickers, but looking at hundreds of stocks and having them aggregated into a single measure of breadth or a series of measures of breadth. And I find a regular process of reviewing those breadth conditions can be super helpful because it's often an early warning system that conditions are changing. The major benchmarks will have a certain look, but the breadth conditions will often change if individual stocks are starting to move and certain themes are coming in and out of favor. As I was looking at the breadth conditions over the weekend, that was for my weekly flight plan for my premium members at Market Misbehavior, we're looking at a couple different measures of breadth, and I wanted to hit on a couple of them here if I could. First off, one of the basic ways of measuring market participation is by looking at advanced decline data. Here we're looking at 4 different measures of cumulative advanced decline data, and it's just looking at different groups of stocks. If we look at the entire New York Stock Exchange, and again, every day, what's closing higher, what's closing lower, you summarize that into a daily change of advancers minus decliners. You accumulate those values over time, and that gives you this cumulative version of advanced decline data. This is looking at common stocks only on the New York Stock Exchange. So it's taking out things like closed-end funds and bond funds and things like that. They're not really a great representation of equity performance. And when you do so, what strikes me first off is that we've put in a clear lower high, right? And again, in the end of August, early September, I think that's noteworthy. In a bullish phase, when conditions are good, the advanced decline data is trending positive because on an average up day, you have more up stocks than down stocks. And the down days are less frequent and usually less painful. And overall, this line should be tracking higher. So if we are in a great bullish phase, how come we're putting in a lower peak for the advanced decline data? Now, again, inspired by my conversations with Ralph over the weekend, what we do not have yet, I would argue, is a lower low. And I think most recently, the advanced decline data all put in new lows there in April, August, or new swing lows as we broke below the 50-day moving average. For now, still a little bit above there. So the New York Stock Exchange advanced decline data is still technically okay until we break below this recent swing low. Again, not too far below current levels. That's a couple down days away from where we're at. We can look at the S&P 500, very similar configuration, not broken, but certainly bending. The mid-cap advanced decline data, same thing, lower peak, not quite a lower low, so we wait. But look at the small cap breadth, right? The small cap advanced decline data. What often happens, and I was taught to look at small caps as a leading indicator. Now that's become a difficult thing to do here over the last couple of years because the markets have been so dominated by the biggest names. But sort of the classic market topping scenario I was taught was you often get small caps breaking down first, usually followed by mid caps, and then the defensive stuff are usually large cap, more established companies. Think of a Pepsi, Walmart type of thing. Those tend to be the last things to break down. That's why the smaller cap breadth usually accelerates lower much more quickly, and usually see the breakdowns there. So I've color coded the small cap breadth as bearish at this point because we have now undercut the August low. My bear case from here, I think the bear case from here would be you see additional breakdowns, and before a corrective phase is over, just like the S&P, we're looking at that August low to see if we're able to make a new swing low or not. I think the same thing for this advanced decline data. If we start to break down, don't be surprised if some of these indicators break down before the price itself does. And that usually means the breadth is probably the better gauge of market sentiment and market participation. Now, again, in terms of things being bending or bent and not broken, I think this indicator sort of combines those and illustrates them very, very well. If you look at the percent of stocks above their 50-day moving average, it's currently around 34%. So about 1 in 3, right? So 1 out of every 3 S&P stocks still above their 50-day moving average. And here's the S&P, sort of still trading below its own 50-day moving average as of Thursday, Friday, into Monday. However, that also means that 2 out of every 3 S&P stocks is below its 50-day moving average. So we think about sort of that classic uptrend, that classic buy on the dips pattern would be a rally in the stock, and then you pull back to an ascending 50-day moving average, and that's where you rotate the next swing high. And we've seen that with some of the charts like Alphabet. Great example of that consistent uptrend where we're above the upward sloping 50-day moving average. You're not seeing that on a lot of stocks, meaning a lot of names, over half of the S&P actually below that 50-day moving average. So it seems to be a smaller and smaller basket of stocks that are actually still looking like Alphabet, and most other things are actually starting to break down. That concerns me because usually there will be some names that hold up pretty well. Maybe Alphabet, NVDA, these are those last ones that are still holding up before we rotate lower. This breadth condition remaining below 50% would reinforce that as a potential thesis. Now, the longer-term version is looking at the 200-day moving average. You can see the S&P is still pretty far from its own 200-day moving average, almost, 300 points away, 270 points away from, today's close down to the 200-day moving average. Meaning we have a lot of ground we would give up before we would be any danger of breaking the 200-day moving average. But about 50-50 split right now if you take an average or take a random stock in the S&P 500 as to whether it's above or below the 50-day or the 200-day moving average. So actually, a bunch of stocks actually already have broken below their 200-day or have been below it for quite some time. And I'm thinking of something like a Paramount or one of those, consistent downtrending communication services or telecom names, already has been in that configuration for quite some time. But this shows you that it's sort of a 50-50 split. So a lot of stocks are below that basic measure of market trend. So as long as this remains above 50% as a breadth indicator, things are just not getting that bad. And I think when you have a clear corrective move, when you start to see some stocks breaking down and you wonder, is this just a shorter term thing or more of a bigger thing? And with a lot of my guests in recent weeks, I've been asking them a version of that question, right? What would you need to see to get super defensive? Like what would tell you, get out of the way, this is a huge problem? And for most of them, it's not been something they've seen yet. Most of my guests are either pretty bullish, given the fact that we've pulled back, or hesitant to be too bearish, given the fact that we haven't broken down a lot yet. And I think I would probably put myself in that bucket as well. One of the things I would look for is to see if this indicator gets below 50%. And if so, that's usually a warning. It's not a guarantee that we're going to go way lower, but it certainly is what previous longer, more protracted corrections have looked like before they get really bad. And so, as long as we hold that 50% level, things aren't getting that bad. We start to break that, it definitely opens the door in my mind to other things getting worse, other breakdowns to occur. Here we're looking at a different way of breadth. A lot of times I scan for stocks making new 3-month highs and 3-month lows, and I found that's a really good way to look for individual ideas with stocks and ETFs. Also interesting just to see what sort of names are coming up. Are they more defensive, more offensive, more growthy, more value-oriented, more cyclical, particular sectors that are emerged. So recently it's been a lot of energy stocks in those new 3-month high scans as they've come back every week. But I'm struck today as I'm looking at the New York Stock Exchange and just the number of stocks making new 52-week highs. So remember, a 52-week high is not common to be broken unless you have something in a really clear uptrend that's just been going and going, or a really clear downtrend that's been going and going, right? A lot of times it takes quite a bit of effort to get to a new 52-week high or a new 52-week low, particularly in a market that's been consolidating like we've been right now. It's been almost identical, to be honest with you. I'm looking at pretty similar amount of green and amount of red as I look at the last 4 to 6 weeks, really from the end of July to where we're at now. I don't know if I would say there have been more new highs or more new lows. It's sort of like a healthy amount of both. And again, when I think of charts that illustrate an indecisive market, a market that is sort of in a consolidation phase, wait and see mode, this is one of the charts that comes to it. Also, this is the difference. New highs minus new lows. Look at how new highs outpace new lows pretty much every day in June and July. Then August into September, it's sort of fluctuating, right? There's certain days when there's more highs than lows and the opposite, right? Vice versa. So I don't think there's a real clear direction here. I think this one tells me we're in that painful third direction. Not an uptrend, not a downtrend, but a sideways trend, right? That third direction. And what you look for, do I start to see more green or do I start to see more red? And just like a stoplight, I think that should, maybe indicate the new phase that we may be entering in. For now, I think it's a holding pattern. Again, given the macro environment, all of the central banks reporting Wednesday, Thursday, I wouldn't be surprised if we continue to hold water until we get some direction. And again, opening the door to lots of speculation about what may come next. Now, the McClellan Oscillator is one I'd like to bring up. It really is more of a short-term indicator. So this is not the particular chart I would use to draw long-term conclusions, right? So when I'm thinking of the longer-term value proposition for equities, I'm thinking more about weekly charts, if not monthly charts. I'm looking at the larger secular trends, which again, even with the pullback we've seen, the longer-term trend I think still remains quite healthy. And you'd have to pull back quite a bit below what we've already pulled back to sort of change the long-term thesis for stocks, I would argue. But you certainly can see some of the short-term fluctuations come out in a chart like this. And the McClellan Oscillator is really meant to turn advanced decline data into a short-term oscillator, which recognizes in the short term whether buyers or sellers are in control. The green shaded areas are when the McClellan Oscillator is above zero. The red shaded areas when it's below zero. And if there's a one-day hiccup, I usually don't change the color. I just sort of assume that that was a one-day thing and that's it. But multiple days on the other side is where I would change the color coding. So on Thursday, I want to say we had a break above the zero level. On Friday, we came right back down. Given what I saw today in the market, this isn't updated for today's close. Monday's close just yet, but I would say pretty much 99% sure it remains below zero. So overall, I think this is still telling you the breadth conditions are more negative than positive. If you're looking for some recovery from here, some indication that we're ready to retest new highs on the S&P or some of those leading names are going to continue their uptrend, I'd be looking for this indicator to get above zero and stay there. Good things happen when this indicator is above zero. It's very rare that very good things happen without that being the case. And so I think it's fine to be patient and wait for some confirmation of an exit from this consolidation of this pullback phase. The chart is telling me we haven't seen it yet. Now, the final set of breadth indicators, really, I would argue, neutral at this point. And I think that's important to remember. Too often when we look at charts, we force ourselves into a binary decision, right? Is it a buy? Is it a sell? And I get asked in the media a lot, no one wants to hear a wishy-washy neutral point of view. It's either, is it super bullish or super bearish? In reality, there are a lot of times when it's neither, when it's sort of in the middle, what some might call like a pair of twos, right? It's not an exceptionally strong hand, but it is what you have. And so you have to do the best with the opportunities that are presented. I've had so many questions recently, by the way, about options and straddles and iron condors and protective puts and covered calls and just different ways to think about low volatility environments, think about consolidation phases and what opportunities you have to have some sort of gain in your portfolio when the conditions really aren't doing it, right? Just buying a stock and holding it is not getting it done, particularly at the moment. So I know a lot of people are looking for other options. So first thing I would say is it's a great idea to be patient, not getting the returns you want and then just trying to pull as many levers as you can to see if something works. That is what a lot of new investors and certainly new traders do. Trading your way out of a tough period is not usually a good solution. It's all about being patient, trust your process, improve your process, but be disciplined about what you're doing. So don't force it. What the indicator here, this is the Bullish Percent Index on the S&P 500. So it looks at 500 different point and figure charts. How many of them are bullish? How many of them are bearish? And point and figure charts, by definition, either are bullish or bearish at any given point. It's all the most recent signal. It either had a double top breakout or a double bottom breakdown. That, any chart has that, except for a new IPO, you can make that assessment. What this indicator is telling you is as of Friday's close, literally 50-50 between bullish point and figure chart and bearish point and figure chart. Now for me, being at 50% is more descriptive. This just more tells you. It's like the RSI being at 50. I don't know if that necessarily, I'm sure it doesn't give you a clear buy or sell signal that on its own, but it does tell you that the momentum is kind of even. This tells me that some stocks are in bull phases and some are in bear phases, but there's no clear dominance of one versus the other. Now, the red and green shaded areas on this chart show you when that is the case. And I think based on this indicator, this isn't telling you anything until we get to those extremes. If we would continue to rotate lower, if we continue in a risk-off move, we continue to see distribution in the markets, I would be very closely monitoring to see if and when this gets below 30%. And in major drawdowns we've had over the last 18 months and going back much further as well, getting below 30% is usually an indication that we're nearing the bottom, and coming out of that 30% level is usually the all clear that conditions are getting pretty good. On the other hand, if we would resume an uptrend, if Apple and others would rotate higher, if Tesla, starts to break out, and NVDA and Alphabet and others just keep going higher highs and higher lows, this indicator most likely starts to improve. And then you look for when it gets above 70%. And even if we're in a bullish phase, that indicator would tell me we're probably nearing the point where we have some sort of actionable pullback. The last signal we got from this indicator was in the beginning of August, when it suggested we are overheated after that April, May, June, July rally, kind of overdue for a pullback. And that's why this drawdown, this consolidation phase that we've seen over the last 6 weeks, I think makes a ton of sense given the breadth conditions up until that point. For now, charts like this really aren't giving you a signal one way or the other. I think it's important to continue to monitor these. Number one, when do we hit an extreme condition? And number two, most importantly, when do we come out of those extreme conditions? These breadth indicators for now are telling you it's mixed. There's no clear strength or weakness on one side or the other. That's our segment, Banking on Breadth. And you get some really interesting mixed signals, I guess is what I would describe it. A lot of them sort of in that neutral bucket. As much as I would love to tell you there's a raging buy signal or raging sell signal, sometimes the evidence is telling you wait and see. As Jesse Livermore, as I've mentioned many times, there's a time to go long, time to go short, time to go fishing. The breadth analysis that I'm looking at is telling me it's that third option. It's time to wait. Let's see what the Fed does. Let's see what stocks do, maybe leading into it, but it's going to be more about what comes after that Fed meeting on Wednesday of this week. I think a lot riding on the sentiment as we digest that information. We got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number one. We're talking about some of the leading growth names in our market recap, and two of the stocks that I think are pretty key right now, NVIDIA and Apple, and just look at how different these two charts are. Again, there are times when I think the FANG stocks, what I call the Phenomena stocks, the Magnificent Seven, there are times when it feels like they're all almost the same name, right? They have very similar patterns, they have similar configurations, but I would say this is one of the times when you're really seeing a divergence with some stocks continue to look good, and NVIDIA and Amazon maybe, but really Alphabet probably the best example, along with NVIDIA, just higher highs and higher lows, no change at this point, versus the Apple, Tesla sort of crowd that has had a pretty quick drawdown and then a clear lower high. And I think until you change that pattern, that's not a bullish chart, but it's not a really bearish chart until you make a new low. And I think that's what some of these stocks are very, very close to doing. Nice bounce today for Apple, further deterioration for Tesla, but I would be watching like a hawk some of those previous lows to see if they're able to hold. NVIDIA below 400, Apple below 170. These are very different charts, and I think speak to a weak environment getting weaker as opposed to a pullback that is starting to rotate back to the upside. Chart number two is looking at breadth by cap tiers. We dug into this a little bit in our segment Banking on Breadth, and I would remind you that classic topping pattern would be advanced decline data starts to put in a lower high. We undercut the previous swing low. That has now all happened with the small cap breadth below its 50-day, retesting it and making a new swing low for the short-term cycle. Do we see a continuation with mid caps and large caps with the NYSE following that pattern? I would be watching this sort of chart to see when and if we break those support levels. And if so, that tells you the breadth conditions are really deteriorating. For now, still neutral orange on 3 of those 4 key measures of market breadth. Finally, commodities. I was looking at sort of a longer measure of commodities. Actually, this is a different chart than I wanted to show you. It's this one right here. Market trend model with Zoom. This is where I wanted to go. I run a market trend model every Friday after the close for the S&P 500, some other asset classes as well. This is a weekly chart of the CRB index. There are a couple different indexes that track broader commodities. We usually refer to the DBC, which is an ETF, but we can run this on any sort of index data, of course, and it's using weekly data to measure the trend on 3 time frames. I think it's worth noting that really since, I would say, June, July, the short-term and medium-term models turned bullish. The long-term model for commodities turned bullish using this index, the CRB index, turned bullish about a month ago. And so long-term, medium-term, short-term, all 3 of these bullish. So while the S&Ps, the short-term just turned negative again on Friday, commodities actually long and strong, according to my proprietary market trend model. So I've learned over time to trust that when this is bullish on all three time frames, that suggests the trend is pretty strong. And all you're looking for is when that short-term model would turn as an initial warning sign that things may be reversing. But while we're seeing some weakness in strength, we're certainly recognizing a weakness in bonds. You're definitely seeing some signs of strength in the commodity space. Folks, that's a wrap for the show. Thank you so much for joining us here on a Monday afternoon for the Final Bar. All of our previous episodes, of course, on our YouTube channel, so check out those interviews from last week, particularly with Ralph Eckenpour and Julius DeKemper. Two great conversations here from our Redmond office. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.